Chit Chat Money is brought to you by Interactive Brokers. Designed for active traders and sophisticated investors, Interactive Brokers offers trading assets in 150 markets with 27 different currencies. Interactive Brokers also charges USD margin loan rates from 5.83% to 6.83%. They've also got the ability to trade stocks, bonds, futures, options, commodities, and more, all from a single unified platform. Brett and I use Interactive Brokers ourselves, and I honestly have to say that if you spend a considerable amount of time managing your investments, if you're spanning the globe looking for new stocks, I highly recommend using Interactive Brokers as your platform of choice. Restrictions apply, but for more information, visit ibkr.com, member SIPC, open an account with IBKR today.
All right, welcome in everyone. This is Chit Chat Money. My name is Brett Schaefer, and it is just me on here today. We have an interview with Jeremy Deal from JDP Capital, and we're talking Spotify. It's not necessarily a pitch on the stock, but we're going to be going through we actually just recorded it, so I know exactly what we talked about. We're going through some of the discovery tools that they're going after, some of the podcast stuff, some of the audiobook stuff, some of the relationships with the music labels, layoffs, corporate culture, a lot of stuff around what the company is trying to build over the long term for their audio platform and the potential there, what's gone right, what's gone wrong, why he thinks the business still has so much potential to grow over the next, few years and beyond, and frankly, for the next 10 years. But I won't spoil the whole thing. Today, we don't have Ryan on the show. He, as we've talked about before, started a new day job, so he couldn't join on this recording for the interview. But don't worry, we'll try to get him on for as many interviews as possible. Just for reference, we do plan these kind of long ways in advance. It does take a lot of planning for these shows, so we had some kind of in the hopper. And yeah, so don't worry about that. He'll be back on for the not so deep dives and the power hours, just like normal. Okay, I think that's it. Nothing else to hit on here. Without further ado, here is our interview with Jeremy Deal from JDP Capital.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schaefer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Anything discussed on Chit Chat Money by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
All right, everyone, welcome in. Today, we are joined by Jeremy Deal, founder of JDP Capital, and I would say maybe we'll call him an expert, say someone that's very passionate, knowledgeable about the audio space, Spotify in general, has been following the company a long time. Jeremy, welcome to the show, and let's talk Spotify. How did you come across them, and how long have you been covering the stock?
Hey, well, thanks for having me on. I'm a huge fan of the show. Love the content, and just grateful to be here with you today. Thanks for that very kind intro. So we bought the stock, I believe, between late December 2018 and very early 2019. So after the direct listing, the stock had fallen about 45%. Had been following the what had been happening in the music industry with the collapse of the industry, and then the resurgence of it with the transition to streaming, and was really fascinated by the opportunity that was in front of Spotify, not just in music, but in the greater audio space. So I think we paid about $115, $118 for our kind of initial position. And it's been a roller coaster since then. It has not always been easy to own it. It's been way up, it's been way down, but I think over the last 5 years, we've compounded about 14% a year in the position, which oddly enough is about where the S&P has compounded since then, and in line with the gross profit of the company, the compounding of the company's gross profit since that time. So a lot has happened. I mean, I feel like the company is hardly recognizable today compared to then. It's up 150% this year, and it just was completely destroyed in 2022. So a lot of that is just maybe offsetting a stock that shouldn't have been down as much as it was. But here we are, and just happy to talk about it.
Yeah, there's a lot of moving parts to this company. For context for the listeners, we're recording on December 12th, 2023. And then I guess some other context. We're not going to hit the basics of Spotify. I know we talked about this a bit beforehand too, about, its business model with the music stuff that's been covered ad nauseum. I guess we were talking about if anyone is more interested in the details of the music industry and how that relates to Spotify and the streamers, I'd recommend go listen to our 2023 episode back in June with Sleepwell Capital. You can find that just in our feed. But maybe some context for you as an investor is give a short story of JDP Capital, because I think that's important maybe for the listeners to understand how you look at investing just before we get into things.
Yeah, so we're looking for businesses that are where the business model is misunderstood by the market, and where there's something going on in the macro, so a trend of some kind that's going to support change and a transition, normally a big transition happening in a sector that we can get in front of and figure out with some kind of a margin of safety, and ideally own the business for 5, 6, 7 years. So looking for companies that can compound kind of like a private equity fund would. They don't all work out that way, but that's generally the lens we're looking for. So companies with unrecognized earning potential. And so we're not necessarily coming in with the business is, a venture type of business, but where the business is self-funding, where there is a path to a really long growth runway that is just not priced in. Usually there's a degree of contrarianism or skepticism in the business when we actually invest. But then over time, that comes and goes. So when we first invested in Spotify, it was a very controversial company. I mean, it still remains controversial around its business model, but we think that that's actually quite a competitive advantage. And so I don't know if that answers the question, but we have a concentrated portfolio, and Spotify has been a large position for a long time, for better or worse. Still believe in the company. Still think the company has a lot of upside, and one of the things I like the most about it is how underappreciated this transition of audio to the internet has been, and the opportunities that's unlocking, and the value migration that's happening away from multiple sectors, and all kind of coercing into the digital companies, the digital apps that control that serve as kind of gatekeepers for the consumer.
Yeah, and for anyone that's more interested in JDP Capital, we'll have a link in the show notes as always to get more information on that. But let's get right into it. There's a lot of like, as we talked about, there's so many moving parts. And then we just have to choose one to go into first. And the first one I have on my list is kind of hitting on the advertising stuff, which is the difference between the audio and the video advertising market, how Spotify's strategy has evolved here. I mean, maybe you can just kick it off in your overall thoughts on their advertising strategy, because that's been the second pillar they've been trying to build. I think investors have been a little bit, maybe they set expectations too high, but I'm curious your thoughts, because people have been a little underwhelmed about the growth there. But overall thoughts, and maybe I'll probably have some follow-ups there too.
Sure. So there's two pieces. I think of Spotify in two pieces. One is the music business, and that has a business model that is kind of well known now, and is not necessarily the greatest business model on earth, because they don't get a lot of leverage, so they get very little leverage. But then they have another bit. But a part of that's just one part of their business model. The other part of it is that they get as the pie grows, their search and discovery tools become more valuable. So labels and just anybody that wants to pay for search and discovery pays, and so that has the offsetting. It's kind of a contra account, and so that has a way of increasing margin. So you have kind of a good and bad, and think of the business model for the music as a little bit of a loss leader. And the third leg to that is advertising. And so advertising originally was part of the reason we invested is because I thought the freemium approach, which is, the freemium approach, the Daniel X freemium approach was genius because if you don't want to pay for the service, you can listen to it, you can listen to an ad-based version of it. So what it does is it mitigates churn. So if you pay for the premium subscription and for whatever reason you can't afford it anymore, or you just get a new credit card in the mail and it takes you a couple of weeks and you churn off on the premium, you're not churning necessarily off the app itself. So advertising supports that. And but advertising was always a small percentage of revenue. I believe advertising is compounded. I mean, since we've owned the stock, is compounded off a very low base, but at about 24% a year. So it's not terrible, but they'll do a little over $2 billion in advertising revenue this year. But there's a lot of nuances to that. So initially, and I think to some degree today, the value of an ad in a music, on the music side is limited because there's just not that much information that Spotify has on you. But as more products are built and as they can leverage their AI capabilities, which they've been working on for a long time, we can get into that later, that they can basically take pieces of information, so pieces of spoken word, pieces of a song, break it down into tempo, break it down into bass, et cetera, and just generate search and discovery. So, and that allows more of an aggregation towards the super fan. So it allows you to discover music that you would maybe not necessarily discover. It increases the value of the back catalog for rights holders and for music labels. So stuff that was long paid for. And just hasn't been necessarily at the top of the charts for a long time. And so you have an advertising model that is the advertising business then breaks down, the model then breaks down to components of search and discovery and just showing an ad or listening to an ad. So we think that now with subscriber growth, kind of hitting, I think this year it was, they added a little over 300,000 subscribers per day. So 110 million subs by the end of this year. As that grows, there's this interesting kind of convexity that happens with the algos that can come up. You can derive just so much more information when there's more people participating on the app doing different things. So where you could infer, I don't know, 100 million different things with 200 or 300 million subs, that may go to many billions with the next 300 or 400 million subs. So so I guess I would say that initially, when you think about the ad market, the value of the ad is only increasing, and I think too we have to separate the value of the music ad and the value of the podcast and now going into audiobooks ad side. So for podcasts, they spent roughly €1 billion. It's been well documented, building a podcast business, and they started building that in 2019 and really got going in 2020. And then we had like a really nasty ad recession in 2020, starting in 2021. So the market, I think, underappreciates the fact that they were really building a podcast marketing business or advertising business really from scratch. It was a very microscopic little industry. It didn't really exist in the way that it exists today. And they were piecing it together with with two primary platforms and a handful of really small acquisitions. And then to then on top of that, once the technology and the ad tech stack was put into place, go through a major recession, an ad recession. It has made on the surface, it has made it appear, like it was a bad investment. And, but we think that, the advertising side, especially on podcasts, will accelerate faster in the next 12 to 18 months than it has previously. So I think we're run rate $2.1 or $2.2 billion. that should be a 50-60% gross margin business at scale, or if the employee base is right sized, as it seems like is happening.
Okay, we want to take another pause today to talk about our friends, Interactive Brokers, otherwise known as IBKR. We love Interactive Brokers. Ryan and I both use Interactive Brokers on a regular basis for our investment accounts. And the reason we love them is because they have the breadth of asset classes and geographical diversification. You can invest in options, bonds, stocks, and in all sorts of markets that you can't find anywhere else, whether it's the Nordics, where we like to research, or down in Latin America, where we also like to research, or in East Asia. You can find stocks that are listed in all these local exchanges, and you can buy them on IBKR, plus so many other features that we've talked about before. If you want to check out IBKR, make sure to go to ibkr.com, member SIPC. If you are a professional investor, if you like doing a lot of research, such as ourselves, which if you listen to our podcast, I think you do, you're going to want to check out IBKR and open and switch your accounts over there today. Yeah, it's always funny talking Spotify because a lot of people are listening to this on Spotify right now, and Chit Chat Money, we're also a podcast that is on Spotify. So we know the advertising, it's probably the right term is a recession, or at least the podcast market. I know people can look at, say, like Google or Meta or stuff like that and say, hey, look, no, they're still growing. But on the podcast side of things, it seems like we definitely were in, I don't know, probably a bubble-ish on spending a little bit. And then now we're coming back to earth. Do you think they need to set up, like, has the groundwork been laid for what they're, at least from our point of view, as someone kind of is industry insiders, I guess, having this automated advertising network where you can set it up very similarly to YouTube, and you have to do minimal work on your end, and it's more of, okay, similar to, again, the YouTube example, where you're not necessarily making a deal with the podcaster, but you're having an advertising slot and then targeting to a specific consumer. Does that all connect back to how you're saying that they're gonna, year by year get better targeting capabilities? Does that make sense? I feel like I was a bit confusing there.
Yeah. No, I mean, it makes sense. Look, there's a lot going on. So let me just step back and talk about how I think about it. So the bigger opportunity is closing the gap, the monetization gap between audio and video on monetization on the internet. So part of the problem has been that you have an enormous amount of content that comes in on spoken word, and is much more of an abundance, much more commoditized and abundant than even music, because at least music is more difficult to produce it. So you have an enormous amount of content, and you have a very, very low frequency of consumption. So part of the issue is it's not just about how can we just insert random ads into XYZ small podcast and hope that the CPM goes up. The solution and the real opportunity is to close that gap by transforming the spoken word, or what is on the internet in spoken word, and this goes for audiobooks as well, down to segments that can be repackaged and redistributed on other parts of, maybe social media, for example. And I give you maybe just one instance. I think about, like, you had your last show was going over some news, and one of the pieces of news you covered the Spotify layoffs, the 70% layoff. I heard that same information why did I hear that same information on Yahoo Finance, for example? Why didn't I have, and what I heard on Yahoo Finance was a 30-second clip. It was a 10-second, it was a headline with a 30-second clip and some random guy just spouting out the similar things. And I think what you all produced was much richer, much more authentic, and much more interesting, even down to that same, 15 or 20-second clip would be much more interesting pieces of what you talked about. But why wasn't that what I consumed? Is it because I'm using the wrong platform? No, I'm using it I'm watching it on a platform that we all have access to. It's because the AI is not what we don't have yet. And what is happening is we don't have necessarily a way to automatically take pieces of that podcast and convert them into sections, convert that into consumable content that can be consumed in small pieces based on relevancy. So you and I may have another example is you and I may have a conversation that spans a wide variety of topics. And there may be 4 or 5 sentences of that topic they're completely unrelated to the other bulk of the conversation. And it might be more interesting to XYZ group of people versus the beginning of the podcast, what was said might be more interesting to another group of people. Well, being able to you can't necessarily manually know the opportunity to maximize the value of those sentences. So this is where I guess you could say generative AI comes in, and what Pods, one of the acquisitions Spotify did in 2001, and just some other work that they've been doing in Gen AI for several years. This is where the advertising opportunity opens up, because it's not just necessarily about how do we take a 1-hour podcast that, and try to convince people who have never listened to the podcast to take an hour of their time to listen to it, and they may or may not be that interested in it. Or if they want to listen to 10 or 15 minutes of it, they don't even know where to begin. So how do we create a product that takes pieces of that and allows ads to be shown depending on where, regardless of where it's being actually consumed. So if you're consuming this going back to the example about Yahoo Finance, well, why couldn't that have been your 30-second clip from your podcast? And why couldn't, and there were ads that were shown against that, whether I consumed it on X, whether I consumed it on YouTube, whether I consumed it on even Spotify. There were ads shown against that Yahoo Finance made money. And this is an example of how you should be able to make money. But no, I don't think that we could just look at, like I said, long form content and hope that, some miraculous way you're going to be able to insert ads that are really valuable and based on the personality graph of the person within Spotify, because Spotify doesn't have information on you outside of what you're consuming in Spotify. But that it's not necessarily a bad thing, and that's not necessarily a game changer. That's what people are used to hearing as a bear case against maybe YouTube, for example. But in going forward, what we know is that the capability exists, and you can already see examples of it in your feed when you look at podcasts. It's pulling out 2 or 3 sentences of a podcast as you scroll through to try to grab your attention. And the sentences that it's pulling out are somewhat customized based on what it thinks you might be listening or might be interested in. And the more products you consume on the app, and the more consumption on the app, the more that they can infer, and the more that the algorithms can pick up and determine, hey, this person might be interested in this short clip about this piece of information here, or that might be, we might be able to take this clip of something you talked about and convince somebody to actually make that 1-hour investment in the podcast. But I don't necessarily think that in the future that you'll have to make that 1-hour investment in the podcast in order to monetize it, in order for the monetization to be effective. So this is where, when I've said before, and I've said in past letters, this is where we think the monetization gap is somewhere between, I don't know, call it 5x to as much as 50x between audio and video. So when you have these big step changes in technology, for example, the transition from the desktop to mobile unlocked, we'd all know and we all understand the opportunity it unlocked in video and monetization of video. But all it did for audio was move the recorded word onto the internet. It didn't do anything more than that. So this is the opportunity, the bigger, long-term, the longer tail opportunity that I think is actually right in front of us and is happening now, to drive not only personalization, but into driving higher margin, higher value advertising. And there's no other way that Spotify could even remotely get to the goals that it has of, I don't remember, what is it, 40% of revenue being advertising or something. But again, they're coming off a very low base, but there's no way they could achieve those goals unless something like that happened. So that's just, I don't know if that's a little bit too much of a deep dive on that topic, but let me know if
That's perfect. No, that's totally
Yeah, yeah.
perfect. The
Okay.
I mean, I think there's a lot of ways to go here. I want to hit on the AI audio capabilities, but one thing that I think relates to, you said, they need to get to this point that you just talked about, the where they can they can bring, the audio market into what it's like with video and have the stuff, where
Yeah, or
there's
a
all this,
version of it. Yeah,
or
a version of it.
yeah,
It's not going
very
to ever be
similar.
the same. We don't expect it to be one to one, but I mean, you're talking about a base. I mean, sorry, you were
I think
saying.
so with podcasts specifically, and with some of the other stuff that relates here as well. You have the competition with Apple Podcasts, and they are maybe a not like dynamic app. We've all had the discussions, or I guess in the podcasting world, about how, they discount
Hmm.
downloads, they don't have the tracking. Spotify obviously has a difficult relationship with them, with their two distribution platforms, Spotify for
Yeah.
podcasters, formerly Anchor, and then Megaphone. Do you think,
Hmm.
how important is it for them to continue stealing market share from Apple? And if they ever got a dominant market share position, like what could that unlock for them?
What do you mean by dominant market share position? Because Spotify has the
Uh,
dominant market share position in paid subscription for music
on
subscription.
on podcasts. So I know they've caught up. They're winning, but say like within podcasts, we're still kind of in 50-50 on our show. I think that's kind of the numbers out there globally.
Yeah,
What could that help with,
yeah.
like the advertising capabilities? Because it seems like when they have to do the advertising stuff with Apple, it's much more difficult, and there's a lot of friction there.
Well, it's, I mean, I think that the value proposition for listening to Spotify is very different than each platform has its own value proposition. It's kind of like buying a car, at least a car that you drive. Um, some people prefer Toyotas, some people prefer Volkswagen, some people prefer Kia. I mean, they are just really different experiences. And Spotify's focus is just adding more and more value, adding much more value than they take. And like they added 300,000 subscribers per day, and this year, and this has been happening despite competition this whole time. So I don't necessarily think that I think the platform is large enough to be able to start making inroads. And again, you're talking about only a little over $2 billion or 2.1 billion or 2.2 billion run rate base. So it's very low. But just back up for a minute. I mean, if you look at let's just say this year consumption, I don't know what total consumption on the platform of Spotify is going to be this year, but let's just say it's 150 billion hours. We'll find out when they file their version of a 10K in Q1 for 2023 year end. But let's just say it's 150 billion hours. If you spread that out over the revenue, the advertising revenue, it's like a little over a penny a minute or a penny an hour. It's almost nothing. So that's kind of where I start and say, it's not necessarily about Apple versus YouTube versus Spotify. Just looking at Spotify's engagement and the number of hours consumed on the platform relative to the amount of money earned in advertising revenue is just mind blowing. Now you could look at that and just say, "Wow, that's really shitty. What a bad business." Or you could look at it and say, "Wow, what enormous upside they have," especially when you compare it to what people spend or how much is earned off of the average hour consumed in North America off video. So just to put a little more context to that, and these are really, really rough numbers. And if somebody has anything to add, please, send me DM me on X or send me an email or whatever. But in North America, let's just say roughly, what we're seeing now in terms of in video subscription, what people are spending on content is on average about $60 a month. So some people are spending 100, some people are only have Netflix and spending maybe 20. And so this is a combination of content usually that is, some is paid with no advertising and some has advertising. So if you spend the average American, we're using the saying 120 hours a month of TV consumption. And they're spending 60 plus dollars a month, plus the amount of money. So that's 50 cents or something, 50 cents an hour. But then you add on top of that money that's earned on behalf of that consumer spending 120 watching 120 hours a month. So you add up the advertising revenue that's earned, the small advertising revenue that may be earned on top of that. So let's just say it's 60 to 70 cents per hour that's being generated from the typical consumer in North America watching television, so the US and Canada. You compare that to Spotify's advertising. So if you're on the freemium model, you're at 1.3 cents a minute or an hour. And let's just say that's double. Let's say in North America, you actually earn double. And the 1.3 is maybe not a fair estimate because it's spread out over emerging markets where the CPMs are really, really low and sometimes non-existent. So India. So let's just say it's double, right? Let's just say you're getting 2 or 2.5 cents per hour compared to between, let's call it 60 cents and $1 an hour for video. So there is, I think my interest and our focus is just the size and the sheer size of the opportunity. If you are a paid premium subscriber for Spotify, there was something that came out the other day on Wrapped saying that some of the more heavy users of Spotify or the premium subs, people that responded to this survey on how often or how many hours do they stream Spotify. The average respondent that's a premium subscriber was like 27 or 26,500 hours per year. Well, there's many examples of people that spend up to 90,000 hours a year, especially, which is, roughly, 3-4 hours a day. So if you think about a young person or that's really interested in, that loves a certain, genre of music or, listens to a bunch of Taylor Swift, or somebody like me who consumes a ton of podcasts and a ton of information for research, it's absolutely normal for kind of consumers or paid premium subscribers to spend 3 maybe plus hours a day on the platform. So if you think about, let's just say the average of premium subscriber is at only 100 hours a month in North America. Well, now you're at you're paying $11 a month. It's like 11 cents an hour. And how much are they earning on top of that or how much is somebody earning in advertising revenue on top of that? So maybe, like we said, maybe it's double the average of 1.3 cents per hour. So maybe it's 2.5 or 3 cents an hour on top. So you're at 12, 15 cents an hour. Best case scenario for a premium sub in North America compared to that 60, 70 plus to $1 plus, per hour in North America in video. So the sheer size of the spread, and look, there's a lot of ways to slice this. And you could argue all kinds of statistics. And there's people probably that have a premium account that never use it at all. And there's people that they're on it 10 hours a day because it's streaming and it's streaming in the background. And so maybe it's skewed. Somebody's account is skewed. I'm just saying that there's no way you could look at this and not see just a gaping hole that's a result of technology or AI that was not necessarily ready for audio when it was ready for video, meaning on the internet, we were able to monetize video much faster and easier than we were spoken word, because the spoken word is just, like I said, the spoken word that was consumed on another platform, either radio or or just between two people, and put online. And that long form content is preventing the maximizing of that value. So whether Apple could obviously do something similar, YouTube could do something similar. It's just the pie is so big, and I absolutely expect all the other platforms to follow Spotify into audiobooks, into using Gen AI models, large LLM models, to slice and dice podcasts and audiobooks and even music, and to be reused in other areas in order to grow advertising revenue. But I would say that Spotify is an enormous platform that people love and will continue to grow. It's 190 countries. They should be at 1 billion subs in 3 years or less, is our thinking today. And again, you're coming off of a low base of advertising spend, and it's a relatively small market cap. So there's always competition, And I think the more that the competition embraces the ability to find a way to, or embraces Gen AI models to maximize the value of spoken word on the internet, it just kind of helps unlock advertising dollars and new creative ways to make money with audio that just didn't exist before. So I think it's a big pie.
Yeah, and you mentioned how far behind audio is. It's very perplexing to me, or I don't even know if that's the right word. Of podcasts started getting popular around 2010, maybe 2008, and it's kind of this upward trajectory. And radio, linear radio, that's the same kind of style and terrible audio quality that's been around for 100 years, still has such a large market share in the United States, where podcasts first started out there. So there's just such a long runway to grow for digital audio. One thing I want to hit that I think we talked about in our pre-discussion that I think is quite important is the Sonantic acquisition and AI-enabled audio capabilities. I know there was a rumor, or not a rumor, I believe it was Bill Simmons at The Ringer mentioned that they're training his voice to do ads in his voice that he actually doesn't say. So you can do these targeted advertisements that don't have to record, 1,000 ads with themselves. What do you think about the Sonantic acquisition and how it connects to the thesis here?
What I like about for all the bad or the crap that Daniel Ek gets for capital allocation, what I do admire about him is I see pieces of Jeff Bezos, where Jeff Bezos would take small shots. And when something didn't work, he would shut it down. And I see that with Daniel Ek. What they do is they make very small acquisitions, most of which don't even have to be reported. It's the only way you can see kind of an aggregate what they've spent on acquisitions in the cash flow statement. So they buy small little companies that they think have an interesting team or interesting tech that can add value to their broader strategy. And I think this is just an example of that. They've made, we know about a lot of acquisitions. Some were really small, 50 million or less, where they got some interesting tech, or they got an interesting team of people. It wasn't successful at all, and they sort of shut it down, or it became the basis or the foundation for something really important for Spotify. Whether it's I think there's a story where they made a small acquisition that turned into what they now have today as the music, like playlisting was, I believe, I could be wrong about this, but I believe the playlists were a result of the technology behind the playlists were the result of a small acquisition. So I think this is just an example of a small acquisition that they made that is super interesting. I mean, if you can take a podcast and press a button and change it to, have it translated into tons of languages. I mean, it just adds, it just opens up, Spotify's in 190 countries, so there's a lot of languages. And if you can make that sound authentic, it's just an enormous tailwind. And obviously the probably even just as big of an opportunity there, and we could talk about this, is audiobooks. So that same tech applied to audiobooks just increases the TAM that much bigger. But again, just to back up to the bigger audio theme, whether it's just spoken word, whether it's podcasts or audiobooks, or just even just deconstructed, just two people having a chat, just an informal chat. There's just so much that can be done with that. That's not just simply putting it on the internet. So, I mean, think about the type, think about text. When if everything was, this was kind of, there's some people that compare, the opportunity in search and discovery and audio to kind of what Google did with text. And maybe it's obviously probably not the same. But just think if the only thing in the early days of the internet, all you did was scan things and kind of put it up in a server. And that was it. There was no way to slice and dice it. There was no way to pull excerpts from something. Or just people wrote an article, somebody wrote an article and you had to read always the entire article. But we've evolved to a world where we can consume text, just pieces of text. You don't necessarily have to read a 10-page paper to pull out, 3 or 4 sentences of something that gives you an answer to what you're searching for. And so this is sort of the broader opportunity in audio, and part of that you're going to have tools in the two-sided marketplace, which is I'm imagining that's where this will go. You're going to need tools that the creator can use to make sure that the spoken word or their product can be consumed, not only on a frequency basis, not only taken down to short form and consumed in many ways that probably they didn't think was possible before, but obviously in other languages as well. So yeah, I think it's one of many tools that are necessary in the steps to evolve the monetization of audio on the web.
Yeah, that's a good segue to another topic that we discussed beforehand. And I thought it was interesting how you framed it as the two-sided marketplace, the discovery as the most powerful tool for Spotify going forward, let's say over the next 5 years or so.
Yeah.
Why do you think that?
Well, because you have, as long as you have consumption growing, you're going to need the more stuff that's on the app, the more product, the more there is to listen to, the more important search and discovery is. So just let's go back to the labels, to the music labels as an example, or even fast forward to the audio, not the audio, but fast forward to the book publishers. I mean, it's a very similar dynamic. We have a handful of maybe three or four publishers that control the industry, similar to the music industry. So the music industry, once they lost control as gatekeeper to the consumer, it completely changed. So as Sleepwell talked about, there's two components to the music business. There's the backlog or the back catalog, and there's the talent acquisition. And they need that to work in harmony. It's kind of like a hamster wheel. You invest, you take this venture capital type of investment up front, and then hopefully, you have this back catalog that you own forever that you can make money on for the next, 50 years. And once they lost control of the consumer, because they used to control the consumer through CD, through radio, through the record shop, et cetera. I mean, they really controlled what you listened to, what came out. And it used to be that if you wanted to build an audience, you'd have to go sell, CDs on the corner for an hour or for $1 or something, and try to get people to listen to your CD and go somewhere where they could find you. So as that's changed, and there's just been an explosion of content out there, audio content. So just talking about music. It does two things. It makes the talent acquisition piece much riskier and more expensive for the labels than it's ever been, because they have to spend a lot more and they get a lot less for it. You don't have to give up your masters necessarily anymore. There's a lot of information out there on that. You don't necessarily, and the deals that are being done with artists are shorter term in nature, and they may not include. They're just not as rich as they used to be. So that payoff that the labels used to get is very, very different. So what becomes more important is maximizing the value of the back catalog that they already own. And when they do have a hit, when they do find something, and maybe they have access to it for 2 years or 5 years or something in the master, they really need to maximize the value of it. So paying for search and discovery becomes more important than it's ever been. In a situation where you just have, I don't know how many songs are on Spotify now. People say 100 million, but I think it's a lot more than that. And then you add on top of that podcasts and just audio in general. It's just an endless supply of two people talking. And now you have audiobooks, which again is just endless amount of listening that could happen. So the more that the barrier to entry, or at least the access to the consumer, is taken away, the more valuable the search and discovery piece becomes. And not just on Spotify, but on all the platforms, on TikTok, on YouTube, on X, on all these platforms. So they're all going to kind of roll between, some version of the top of funnel, and you're going to pay for that. And, a lot of this content becomes a CAC, or customer acquisition cost, for something else that the rights owner wants to sell or was attached to that right. So you might be willing to invest a whole bunch of money in a certain song or a certain podcast or a certain book in order to sell an adjacent product that really has nothing to do with that. Maybe it's an artist wants to, sell clothing or something, something completely unrelated to it. So you need to build that super fan audience. And so regardless of what the audio is, just like in text on the rest of the web and video, search and discovery is everything. And that's where ultimately the value will accrue. And it'll accrue to those platforms that have the widest array of consumption and engagement on their platform. And Spotify is one of those. It's just, not a $2 trillion company.
Yeah.
That's kind of the bigger story, the bigger picture idea. And why I think the two-sided marketplace, which was built, started at less than 20 million in revenue in 2018. It's probably, we're guessing is 300 million in revenue USD roughly this year. I think it'll be, 10% of gross profit, maybe next year, the year after. But I think what they've learned with that model is how to apply it to other verticals. And audiobooks is the latest vertical that they'll be applying that to. Because it's clear that authors aren't really making any money. I just finished the Elon Musk book, listening to it on Spotify with my 15 free hours of my premium account, and I don't know how much money is going to that author, but it can't be much. And so again, like over time, this is the opportunity to charge people for search and discovery. I think is an interesting avenue when you add on top of it all the tools like we just talked about, like voice and language, stuff like that, translation, publishing, digital publishing. Those are just tools that the way I think of them inside of a bigger two-sided marketplace that goes beyond music.
Yeah, and I think that's an example of that, because for anyone that's not maybe super honed in on this industry, it can be hard to wrap your head around, or even if they don't use Spotify. I showed with you before when we were doing kind of prep for the show is a new thing that they give out on the Spotify for podcasters, which if you don't know, for any listeners, is how you distribute things. Is they give a Spotify impressions data source, which is not listens. It's more of like how many times has it been searched, your podcast, or for us it's podcast, but it could be music, could be audiobooks, could be whatever, on the Spotify homepage or the Spotify search results or in your Spotify library. And I mean, right now for us, they're giving us over 100,000, I guess it's free, impressions at this moment because we're not paying for anything, but that's very valuable. They're surfacing that stuff for discovery. Now they're doing the changes on the homepage, and kind of part of your thesis, it seems like, is that they've applied some of this to music, and there's still a long runway to grow for music, especially as they add 100 million users every year. But that can also be applied to podcasts fairly seamlessly, because there are some nuances, but when it's search, when it's discovery, they'll figure out the nitty gritty, but it's not that much different at the end of the day. You're providing so much value for a podcast such as Chit Chat Money or the millions of others around the globe, and they'll take a cut of that at the end of the day.
Absolutely. The dynamic ad insertion product, moving away from the RSS feed, all that. I mean, I think that the business is being built on top of music. And I've said this from the very beginning of buying the stock. I think the businesses being built on top of music are going to be much more valuable than music itself. I think music is simply just somewhat of a means to an end. And that is definitely not a mainstream view, but that's how, we're looking at it. I think the parabolic growth curve of the business is definitely in front of us and not behind us. And it's because, and again, why I think the company ended up being so bloated is because there's this understanding that people that, understand the opportunity. When you see the size of the opportunity, I could see how, it's really a priority for the business, or really a priority for the team, for Daniel Ek and the team to really push forward into these other verticals and apply what they've learned in music to their verticals that I think could be that don't have the baggage that the music deals, the typical music label agreements have. So
Yeah.
like
No, I mean,
audiobooks.
it's interesting. Do you want to talk anything in audiobooks? I do have we have something on the podcast content strategy, which I know is a big, I don't want to call it bear case, but it's a gripe investors have. So do you have anything else on audiobooks, or should we get to the podcast content stuff?
Audiobooks. I mean, it's interesting. The way it's evolved is not the way I thought it would evolve, but I'm actually happy with it. Like 15 hours a month with a premium subscription, and then you have the option to buy more. It's great. I mean, just think about, again, what I like about it is think about how small that industry is. So books, what I read online, this could be wrong, and if I'm wrong, please somebody please correct me. But I read it's like 140 billion a year business, just books, publishing. Audiobooks are like 5 billion, but then streaming audiobooks, so where you're not actually purchasing the book online like Audible, where you're just streaming the content, is way less than 5 billion. I couldn't find a number on that, so I would assume less than half. And so what they're doing is when they bought Findaway Books, which is the platform they're using to grow this business, which was the number one player in audiobook distribution and tools to creating audiobooks. What's attractive about that business is the margins are much higher, because the platform where an audiobook is listened to generally takes somewhere. I mean, I read that Apple takes around 45%. Audible takes between 25 and 40%, depending on if you're exclusive with them or not. So let's just say 45%, because that's what Apple takes. They'll take plus you pay for tools to build. So if you want to publish, it used to be a really big deal to create an audiobook, which is why there aren't that many audiobooks out there relative to the number of books. And there's actually a lot of podcasts you can listen to on how to create and how to build an audiobook. And it's just fascinating how difficult it is to find a narrator, to get into different languages. It's just tedious. It's difficult to find the right person to read it, and then the right person to begin and end on the same tone, and to begin the book and end the book with the same, without sounding exhausted, and to find a voice that actually resonates with the crowd, with the listeners in that culture, in that country, in that subsect of people. So it's fascinating. So there's a clear opportunity there, and I don't know how that's going to shake out, but I can imagine that it's going to be a big opportunity for the audio industry, or for the audiobook, or just the book publishing industry generally, and they may not realize it yet. Maybe they do, but there's been a lot of negative press because they're worried what happened to music is going to happen to them, meaning all this, the value goes to the very top percentage of books, but the most successful books. But I think there's, it's just a fascinating opportunity, because you're starting off just such a small base. You're marrying something that's so important to the average person just consuming books, with 600 million subscribers, and a revenue base, an industry revenue base that's almost laughable how small it is in size, which is where podcasting as an industry was just a few years ago, 2-3 years ago. So I just love that setup. To me, it's interesting. There's just a lot of ways to win, a lot of ways to the top of the mountain.
Yeah, I mean, it seems like there's a ton of opportunities there, and it's hard to kind of formulate what their thesis is so far, but hey, they've been very successful. I think even the most bearish person on Spotify cannot complain. They make a good product for their users, and I wouldn't doubt they're going to do that with audiobooks as well. Yeah. One thing that I mentioned before we talked audiobooks that a lot of investors complain about, you see it in all these news articles, is the podcast content strategy, spending all this money. They had the bad deals. Right. I think they would admit, with kind of going after some celebrities for some hype, the Kim Kardashian deal, the Meghan Markle deal. And we talked about before about why this may not have been a mistake. Those specific ones obviously weren't the greatest deals, but I kind of agree with you there. And I'm curious your take, how spending on Joe Rogan, spending on the Call Her Daddy show, spending on some of these big shows to make them exclusive or just within their network, why it can be so valuable for them and why they might be getting good returns on these expensive looking deals.
I think it's very easy for the media to talk about these high profile people like the Meghan Markle situation. I mean, my understanding is that, I mean, I don't know how much they lost, but it wasn't much. It's just pocket change. I think that, if you back out the Joe Rogan deal, how much was actually lost in content, content that they produced. I just don't think it was much. And I think, that's part of the recipe when you're inventing an industry is you're going to have to break some eggs to make an omelet. I mean, if we applied this to any other industry that was a startup, that was just starting up from scratch, of course you're going to spend 10 basis points or 20 basis points of revenue or gross profit on trying a whole bunch of things and seeing what sticks. The bulk of the money was spent on the platforms that they acquired, which were home runs. I mean, you could not, let's invert this. Could you spend $1 billion today and be in the place that Spotify's in with podcasting? Absolutely not. Absolutely not. There is no way that for $1 billion that a platform of its size could press a button and have, I don't know, 50, 60, whatever. I'm afraid to say what I think the consumed hours and outside of music is, but let's just say it's 30 or 40 billion hours a year. To press a button and own an industry like that, or maybe I guess technically they're in second place to Apple, sort of, if you just look at podcasts or whatever. But you couldn't replicate that for $1 billion or a billion euros. So yeah, they broke a few eggs along the way. So what? It makes for great headlines because you're talking about celebrities. Longer term, I don't think they want to own any content. I don't think that they're a content business. YouTube doesn't own any content necessarily. I mean, they're not really in the content ownership of podcast business. And I don't think that they necessarily, that Spotify sees itself as a content owner. I think they felt that they needed to acquire some famous people initially and produce some podcasts on their own so they could experiment. Think about it as McDonald's. Like, McDonald's is a franchisor, but they still actually own a handful of their own stores. Why is that? I believe that one of the stores they own is in Paris. Is one of the highest grossing stores in the world. The franchisor will always keep a handful of stores so they can learn, so they can test things. And I think that, maybe Spotify will always have one or two things that they own, maybe, but I don't think they necessarily want to be in the podcast content ownership business. I mean, they've talked about this extensively, but when the industry was just getting going, I think it made sense to like I said, just to experiment, get some people on the platform with some high profile names, and with the goal of bringing on other people's podcasts of highly produced content onto the platform. And I think that's been very successful. So I don't think you can name, a list of successful podcasts that are not on Spotify. So whether they're owned by whoever owns them, name any of the competitors that also produce content, that you can generally listen to everything on Spotify as well, because that's where the consumer is. That's a key place where the consumer is. And so in a way they've won. And if you look at that as a return on investment, it's been a great investment, because they now are, what they want is the New York Times, that they want everybody to put their podcast through onto the platform, and use their dynamic ad insertion to decide how they want to get paid. Do they want to get paid in a subscription? Do they want to get paid in ads? How do they want to share that ad revenue? How do they want that to look? What kind of ads do they want shown against that content, et cetera? So that's really the long-term goal. And I think people were completely overreacting to this, this spend. Again, even if you look at the total 1 billion, it's just not a lot of money, especially relative to how much money the music side of the business makes. We haven't really talked about financials yet, but it was from day one, we could see that Spotify just prints money. I mean, there's actually, I know it doesn't on a GAAP basis make money, but we think the music business may require 1,000 people, our guess. We look at Deezer. Deezer has 600 employees. I mean, I know it's a much, much smaller business, but How many employees do you need to run that core music business? So I think it's a little bit like Amazon back in the, a decade or 2 decades ago, when everybody complained about profitability, but it was actually a very profitable business that was reinvesting 100% of its gross profit back into the business. And I think that's what was happening. I think you have a core music business that's making somewhere between 1.5 or 2 billion euros. If you were to take it down to its bare bones status and say, okay, how many employees do we need to run this? Maybe it's a few hundred, maybe it's 1,000 employees, compared to, let's call it 3 billion in gross profit. It's a very profitable. I think it's a very profitable business. It's just that they've chosen to reinvest that, and they have a long runway to do that because they make enough money on the music side. So again, yeah, I think the podcast stuff, the 1 billion invested is a drop in the bucket and something that couldn't be replaced, and we will look back on as a genius move.
Yeah, and you mentioned financials. We're gonna, I think, as we wrap up here, we have a couple more questions, so we're still gonna go for a little while.
Yeah, sure.
We're gonna come back to a little bit more of the financials, a little bit more of the investing things. I know all that stuff connects together to their long-term competitive position. I think maybe first, this is a bit of a smaller one, but the price increases on the music side of things, I think from my seat, is a bit underappreciated. Actually, well, it may be appreciated a bit better now, but after they did the price increases, it's been a little bit more appreciated. I think two things there. One, how much can they continue to raise prices in these wealthier markets? Because I know I always like to ask friends, since I'm very interested in following the stock. It's boning for sometimes it's been on my watch list for a long time. And I say, hey, like, look, did you see that they raised prices? And they usually either say, like, no, they didn't even notice because, the value is so high. Then I was like, they raised it by, they're like, how much did you raise it by? And they're like, oh, they raised it by $1. And like, oh yeah, I mean, well, they could raise it to 20. I'm not going to cancel. And then the second thing I want to talk about is the better potential unit economics they get when they raise prices for these new dollars that they're sharing with the labels.
Yeah. Pricing power is a function of how much value they're delivering for the consumer. So I think if it was just a music app, it would have less pricing power than a music app plus podcasts. If it was just music and podcasts, it would have less pricing power than music, podcast, and audiobooks. So the more value they add, the more people are willing to pay. And I think with audiobooks just getting started, it just makes $11 a month seem like a very, very small amount of money. I mean, it took Netflix a long time to raise their prices above $10 a month. But when they started, once they realized how hooked people were, and again, this is in the face of YouTube, which people talk about millennials and everybody just watches YouTube all the time, but Netflix just has produced incredible pricing increases. They've proven pricing power and resilience there, despite all the competition, an enormous amount of competition. Apple TV, in front of all that, Amazon, they still are able to keep on increasing prices. I think it's over $20 a month. Is it $19.99? It's $20 a month or something now for the ad-free Netflix subscription. So. I think there's, as they add more value, they can increase more. And I think it's a very undervalued service now, especially with audiobooks. Absolutely. As we know, just listening to earnings calls, they hesitated. They weren't raising prices before, not because they didn't think they couldn't, but because they weren't getting any leverage from the labels. And I think they held the labels' feet to the fire and said, spend what I think happened. And I think this sort of echoes with what Sleepwell was saying on the interview in June that we talked about at the beginning of the conversation, was I think that it needed the labels realized, like, okay, wait, Spotify is, if you look at the risk profile or the risk section of the music labels, Spotify is the very first section, risk section. I mean, it is, it's a very important part of their revenue model and their financial profile, and they're set up for growth. And the expectation of terminal value in the music labels is linked to the ability of Spotify to be able to raise prices. So, that huge multiple, that high multiple that you're basically paying for Universal Music because it's, a steady Eddie kind of mature business with high returns on capital. Well, if something were to happen with Spotify, that would change. They need Spotify to be able to move forward and raise prices in order for them to also grow. And yes, they're doing business with a lot of other people as well. They're doing business with TikTok, they're doing business with Apple, they're doing business with Amazon, et cetera, but all in very, very different ways. The way they do business with TikTok is very different because it's short. It's not as much of a music consumption business. The money that the value of a 10 or 30-second clip is different than listening to a whole song on Spotify. So Spotify is a really critical piece to the growth trajectory of the music labels. And I think Spotify recognized that the leverage they had and negotiated better terms. And they've said basically that on earnings calls, that they now have the leverage to move forward. And what I think the leverage is more spending on two-sided marketplace, which would completely make sense because in the research we've done, speaking to people at the labels, they don't think that they spend much with, the ROI that they get on the two-sided marketplace is generally very high. And, roughly $300 million, which I think it is roughly what it is in 2023. It's just not a lot of money. Again, these are small, we're still on a very small base here. So they could absolutely spend more. It makes sense for them to spend more. And I think they can also retain the structure of the deal that they had before and just show the same leverage that they're getting. They can show price increases on their side. They can show the benefit of the pricing. Labels can show the benefit of the price increases from Spotify flowing directly through. And all that maybe all they have to do is move around some of their R&D and marketing budget over to the two-sided marketplace. And there's probably a schedule to do so. And that is very win-win for both sides because Spotify gets a bump in margin because it's, again, a contra revenue line item, which goes it reduces the, it's margin expansionary, but it's a contra account. So it gets billed as a reduction in the amount of money that's paid to the labels, if that makes sense. And the labels retain their model that, so I think that is opened the doors to potentially more price hikes as Spotify adds more value to their user base. So I could see it being, depending on how much they add, there's a fourth vertical coming. We don't know what it is, but a guess is that it's something in education. As more and more things are added to the platform, they can add more stuff. But even as it is now, it's undervalued. So I think pricing power is definitely not the question here. It's more about the deal they got with the labels, which like I said, I think that what it is more spending on the two-sided marketplace, which comes out of their, R&D or sales and marketing budgets. So more to come. It's probably just the beginning. I think it unlocked what could be a cycle of raising prices going forward.
Yeah, I wouldn't be shocked if they added once every 2 years or something like that, and nothing changes with churn, especially as they keep adding more value as you mentioned. Now, today and it might be different because I know sometimes it's tough since they report in euros and the currency stuff can make it be slightly different depending on what source you're using at what time. But they're closing in on $3.5 billion in US dollars in gross profit on a trailing 12-month basis, or they'll probably be close to that in 2023. With that context in mind, how large, maybe from both users and financials, is Spotify's market opportunity?
So we have them doing 3.4 billion euros in gross profit this year. So it's whatever, $3.6, $3.7. We have them doing something like 4 billion next year, maybe getting close to that, and 5 billion run rate by exit 2025. So I think the opportunity is more in the margin expansion. It's also in top line growth for sure. Generally 40% of freemium converts to premium. And as there's more reasons to convert to premium, like audiobooks and the fourth vertical that's coming, and a better experience on audio or with podcasting, I wouldn't be surprised if they can continue that 40% conversion rate. So yeah, you have opportunities kind of all over the place to make more money. There's so many. What I like about Spotify is, unlike a lot of most investments that we make, there's just so many paths to the top. And over the years, I look at our internal model and I just see how it's changed and grown, and how we were so wrong about other things, but so right about other things. But then in the end, it all sort of matched and worked anyway, because something went up here, went down over there, and it's just an interesting company. It would be like trying to underwrite maybe, like I said, we talked about Amazon earlier. Underwrite Amazon, 10 or 15 years ago. There was just a point. Not that it's going to be Amazon or it has that kind of upside, but there's a point where you just have to kind of have a vision, and you need to see that the team is executing on that vision, and that the vision is backed by just an enormous market opportunity, just a wide open market opportunity, and that they are the dominant or a dominant player with the financial resources to execute on that. And so I don't know how big it can be, but I think it can be materially bigger than what it is today. So, just looking at the next 18 to 24 months, let's say you have, let's say, and this could be too optimistic, so don't hold me to this, but exiting 2025, like a 5 billion euro run rate gross profit. And we're hoping that after the layoffs that they can hold their total expenses to run the company around 3 billion. There's an analyst that came out yesterday, I forgot who, and raised their price target to 300 euros per share, or dollars per share, sorry, based on very similar math, but for 2024, saying that he thinks that gross profit next year will be 4 billion, and costs, they can get costs down from 3.4 billion after the RIFs to roughly 3 billion next year. So that is roughly works out to about 1 billion in operating earnings or EBIT. So, I think the market is probably looking even past that and discounting maybe 2025, which looks, 2+ billion in EBIT. And so, yeah, it's, that's kind of where I think about it today. But it's that inflection. This company has been hated for a long time. I've had this conversation with even other tech investors, among people that I know that are really good tech investors. Very few of them, some of them, but very few of them either have an opinion on Spotify or continue to own Spotify, after maybe owning it in the past, because they just, they're just confused on kind of how things are going to work out, and they're tired of waiting for this inflection to happen. And I think with the rifts that happened recently, you're now going to see underneath the hood the earning power that exists now under the hood, which was not really visible before, and it's going to open up, and you're going to also see you're going to see the earning power going forward, a lot easier as well, because by seeing what's under the hood now will allow people to extrapolate, the next 24 months or 18 or 24 months a lot easier than they're able to do today. Because I don't know, street consensus was like 500 million and 500 million in operating earnings for next year. And that just seems like, or in 2025 or something like that. And some of these sell side reports I read are like, yeah, maybe the thing will make $1 billion by 2027. You're like, are you kidding? No way. Like the stock would not be where it's at if the world really believed that that's all the earning power that it had was $1 billion or 1 billion euros by 2027 or 2026. So I think these riffs will show people give people a little bit of a glimpse into what's going on, or the earning power of the business, and what is capable going forward as we start to get leverage in some of the stuff we just talked about.
Yeah, and you just mentioned the layoffs. I think we don't. If you don't have anything else on that, that's all right. But what are your thoughts on their corporate culture in general? I know a lot of people have, as you mentioned, investors are quite negative on their corporate culture. So what are your thoughts on that? And maybe thoughts on the CFO transition too?
CFO transition, I guess, makes sense. I don't work there. I'm not on the inside, so I don't really know. But I guess looking back and reading Daniel Ek's letter totally makes sense. Somebody said on Twitter he's a ZERP era CFO, and maybe that's true. Um, it's a Swedish company, so it's very different culturally than an American company. In America, you go down a very long list of public companies that have done major layoffs this year, major layoffs. So from Salesforce all the way down. Well, I guess Twitter or X laying off 80% was pretty extreme, but a lot of the small caps I cover have even had pretty big rifts. And not just in tech, by the way, but across the board. So there's been a lot of right sizing that's happened this year, but tech, it's been, I'd say 10 to 25% layoffs generally across the board. Stuff that we don't know but just cover. I mean, you could just kind of Google it. I mean, it's Twilio, it's Appfolio, just a long list of these companies that have laid off. It's Meta, right? It's Google. They've laid off just tons. It's Amazon that laid off. I don't know what percentage of their white collar workforce they laid off. It was like 18,000 people, white collar, and I don't know what percentage of their total that is. People refer to it as a percentage of 1 million plus workers. That's not right, because they were laying off corporate people and not people on the front line, at the warehouses or in the grocery stores. But so everybody has gone through this. So I think this just needed to happen. It's happened later than it should have. The company has been overstaffed since it went public. And my sense, talking with a handful of people that have worked there or working there, I've always heard that the company is overstaffed. But I think there's some cultural differences. If you look at the 1,500 people that were laid off in the spreadsheet that's going around, and most of them are U.S. people, many of them are in New York, so very high salary people. It's not just the salary though that's going to save costs; it's the cost maybe around that person, what the person was spending, and the social benefits, just the U.S. the employer taxes associated with that, which can be 15% of the person's salary. So I think they can absolutely save. My guess is this is 350 to 400 million euros in savings, and it'll happen immediately. From what I understand, everybody was shown the door and given 5 months salary. So you're going to have a big one-time hit on next quarter's earnings. And then after that, it'll kind of be bygones will be bygones. So I don't know about the corporate culture. My sense is that it went from a very decentralized kind of work environment to now a much more trying to centralize the work environment and get a lot more control over what's happening in the business. That's just my sense. I mean, from what I know about other Swedish companies that I follow, they tend to be very flat organizationally, and Spotify, being a big global tech company, can no longer, if they want to be a player and become a 400 billion market cap company someday, they're going to need to look more like a U.S. company from that perspective, be a much more aggressive, hold people to the fire more, be quicker to fire, do more with less, and not be such a flat organization where maybe everybody has a large number of people have input into a decision. Maybe decisions need to be more siloed. And I do believe that's happening at the company, but I'm just comparing that to maybe what I know about culturally about other Swedish companies. I do think that's what separates them from other smaller Swedish companies that just can't find their way out of Scandinavia. Is Spotify is willing to do whatever it takes, and it's very clear with Daniel Ek and Lorenzo that they're willing to do. Their board is a global player board, and they'll do what it takes to be successful. And so, the rifts were positive, I think.
Yeah,
and I guess the CFO had to go. ZERP CFO. I don't know.
I think maybe they. I don't know what really happened there, but they clearly had too many people, as you said, versus a company of their size. And as we wrap things up here, this has been a fantastic discussion. We had a lot of reasons to be optimistic on Spotify, the podcast, the advertising, the AI stuff, the discovery, how it all connects together. I think if listeners kind of picked up, we try to stay neutral as the interviewers here, but I'm also optimistic on the potential of the platform as well. But we got to talk pre-mortem. We asked this for every company. Why does the stock perform poorly over the next decade?
the easy answer is that they just can't grow. Every company to be successful, it needs growth. And if for some reason they just can't grow, and that's a combination of things, a combination of users, they still need to get their user base. I think their user base needs to be bigger. 600 million is a little bit small relative to the real heavy hitters, relative to YouTube and Meta, which both have more than 2 billion users. You need to get that user base up, and they're doing a really good job. But I think that would be one reason. Second, there could be some technology out there that we don't know about today that's being created in some Silicon Valley garage that snatches the eyeballs away, that moves that changes the way that we, how we consume things, or the attention, that takes our attention away from apps like Spotify and YouTube and takes them somewhere else. I don't think that the death of Spotify has anything to do with crypto. I remember that was a little bit of a scare back a couple of years ago. People thought, well, if you just change the way music is owned, then it would just disintermediate Spotify. But Spotify's value add is again aggregating and search and discovery, which has nothing to do with the ownership of the music. So I would say those two things: if it can't grow, and or growth stalls, and they just are kind of subscale, which they are, like I said, subscale relative to the really big players, and or there's just some sidewinder technology that comes out and just says, hey, we no longer consume our music on these apps. We do it somewhere completely different. Those are the two things that come to my mind. Of how potentially there could be some component to LLMs could, we talk about all the benefits to Spotify, but these LLMs are also benefits to anybody on that end of the stack, where on the application side. So it's the same reasons that Spotify, the same opportunities that Spotify has in Gen AI are the same opportunities that Apple has, the same opportunities that Google has, and Facebook, et cetera. So nothing is a slam dunk, and we need to be humble and stay humble and be willing to say, hey, pull the plug if we need to. But up until now, I've just been really encouraged with the progress. And I think the progress that's happened in the last quarter, especially with the layoffs, is really a step in the right direction. So as long as the valuation doesn't get too far ahead of us, it's a mid-30s billion USD market cap company. It's not egregiously valued, and as long as that doesn't change, I think we just kind of watch it closely and see how things develop.
All right, that's a great way to end things. Thank you again, Jeremy, for joining us. Now, where is the best place? We'll include these again, as I mentioned, in the show notes. Yeah. Where's the best place for people to find you?
People want to follow the fund. It's jdpcap.com. And if you're a qualified and accredited investor, you can sign up and get our stuff as we get on our distribution list. And I'm also on Twitter, a little less active, or X, I guess I'm a little less active, but try to post things from time to time, but definitely check it. So feel free to DM me. It's Jeremy_deal. And those are probably the two best places to find me.
All right. Let me hit the disclosure. Ryan and I are not financial advisors, and nothing we say on this podcast is a formal advice or recommendation. Ryan, me, podcast guests may hold securities discussed in this podcast, may have in the past, right now, or may buy or sell them in the future. Thank you, everyone, for tuning in, and we'll see you next time.